Hello and welcome to the Commodities Institute podcast. I am Emily Costa, and today is Monday, January 19th, 2026. We have a massive amount of data to pass through today as the final figures for 2025 have rolled in, painting a picture of a global market in a state of profound transition. From industrial shifts in the Far East to major corporate movements in North American energy infrastructure, there is a lot to uncover. We begin today with the metals sector, where the world's largest producer is showing signs of a significant structural slowdown. For the first time in 7 years, China's crude steel output has dipped below the 1 billion metric ton mark. The final tally for 2025 came in at 960.81 million metric tons, which is a 4.4% decline compared to the previous year. This is the lowest level we have seen since 2018, and it is a direct reflection of the persistent and protracted downturn in China's property market. However, while domestic construction demand is flagging, Chinese steelmakers are not sitting idle. They have pivoted toward international markets and higher value products. Steel exports surged to a record last year, exceeding 119 million tons. We are seeing a major shift in production away from construction-grade reinforcing bars, which fell to just 13% of total output, but toward flat steel products like hot-rolled coil used in manufacturing and infrastructure. Despite the lower overall output, profitability for steel makers actually improved last year, with more than half of the mills reporting profits compared to just over a third in 2024. Looking ahead to 2026, analysts expect the contraction to continue, albeit at a slower pace of around 3%. While the steel industry is contracting, China's energy landscape is undergoing an even more historic transformation. For the first time in a decade, thermal power generation in China fell in 2025. This is a massive signal for the global energy transition. Thermal electricity, which is mostly coal-fired, dropped 1% to 6.29 trillion kilowatt hours. What makes this truly remarkable is that it happened during a year when overall electricity consumption actually climbed 5% to a record high of more than 10 trillion kilowatt hours. For perspective, that is more than the combined consumption of the European Union, Russia, India, and Japan in 2024. The gap is being filled by a surge in renewable energy. Hydropower and nuclear power both saw healthy growth, and while the official statistics on undercount smaller-scale solar, the trend is clear. The growth in clean energy is now meeting the growth in demand, suggesting that fossil-fueled power may have hit its structural peak in the world's largest energy market. However, do not mistake a drop in coal-fired power for a total slowdown in the fossil fuel sector. If we look at the oil and gas data, China is still breaking records. In 2025, Chinese refinery throughput hit an all-time high of 737.59 million metric tons. That is approximately 14.75 million barrels per day. This growth was driven by capacity expansions at national oil companies and the ramp-up of the private mega Yulong refinery. Domestically, crude oil output also grew to a record 216.05 million tons, or 4.32 million barrels per day. Much of this success comes from offshore drilling in the Bohai Sea and the South China Sea, part a 7-year energy security push that began back in 2019. The geopolitical side of the oil market is equally fascinating right now. We are seeing a significant reshuffling of Russian crude oil flows. China's imports of Russian Urals crude have reached their highest levels since mid-2023, currently at about 405,000 barrels per day. This shift is happening because India, previously the top buyer, has sharply cut its imports due to Western sanctions and an upcoming European Union ban on products made from Russian oil, which is set to take effect on January 21st. Because Indian refiners export a significant amount of diesel to Europe, they have to run their facilities clean of Russian crude for at least 2 months to remain eligible for those sales. China, which exports very little to Europe, has been more than happy to snap up the discounted Russian barrels. In fact, Urals has become so cheap that it is now competing directly with and often undercutting Iranian oil. Late last year, discounts for Urals were as wide as $12 per barrel against Brent, making it even more attractive than Iranian light. Moving to the agriculture sector, we are looking at a more subdued year for palm oil. A recent poll suggests that Malaysian crude palm oil prices will average about 4,125 ringgit per metric ton in 2026, a drop of about 2.5% from last year. This is largely due to higher supply and a shift in biofuel policy. Indonesia, the world's top producer, recently scrapped plans to move to a 50% biodiesel blend, known as B50, opting instead to stay at the 40% level due to funding and technical constraints. This has shifted the market's focus from a potential demand surge back to the reality of ample supplies. Favourable weather has boosted stocks in Malaysia to their highest level in nearly 7 years, and Indonesia's production is expected to hit a record 51.2 million tonnes this year. In Europe, the agriculture story is one of anxiety and protest. Greek rice growers are sounding the alarm over a new free trade deal between the European Union and the Mercosur bloc in South America. Under this pact, which is set to be signed this Saturday, 60,000 tonnes of duty-free rice from countries like Brazil and Uruguay will enter the European market over the next 5 years. For growers in northern Greece, who are already struggling with high production costs and competition from Asian imports, this feels like a breaking point. Prices for Greek rice have already halved over the past year to 25 cents per kilo. Many farmers in the Thessaloniki region feel they have no choice but to abandon their fields, as the soil there is largely a monoculture specifically suited for rice. Finally, we turn to the dry freight and shipping sector, where China has achieved a long-term strategic goal. On January 17th, the first shipment of iron ore from the Simandou mine in Guinea arrived at Majishan port. This is a major milestone for Beijing's supply security. China currently relies on Australia and Brazil for 80% of its iron ore, and Simandou, with its 65% high-grade ore, represents a critical diversification effort. The project, which has seen heavy investment from Chinese state firms and Rio Tinto, has a planned yearly capacity of 120 million tonnes. Meanwhile, in the grain markets, Russia's seaborne exports showed resilience in December, rising 4.4% to 4.7 million metric tonnes. However, the season as a whole tells a different story, with total exports down about 7% due to smaller crops and government-imposed export quotas. In North American energy news, we are watching a potential shift in ownership at the massive LNG Canada project in British Columbia. Sources indicate that both Shell and Mitsubishi are exploring the sale of their stakes. Shell, which holds a 40% share, could offload as much as 3/4 of its holding. This move comes at a time when the facility is operational but facing technical hurdles. Its second processing unit was reportedly down in December. Even so, the project has a major cost advantage due to cheap Canadian natural gas and direct access to the Pacific. A buyer for Shell's stake could be looking at a commitment of roughly $15 billion, which would include the capital needed for a proposed Phase 2 expansion that would double the facility's capacity. It is a fascinating time to be watching these markets. The data suggests that while the old industrial drivers like steel are cooling, the global trade in energy and raw materials is becoming more complex and more competitive than ever. If you found this episode valuable, be sure to subscribe, share, and leave a review. I'm Emily Costa, and thank you for listening to the Commodities Institute podcast.